Okay, good morning, guys. Hope you enjoyed the bank holiday weekend. That is it. I'm afraid, basically, summer's done. Time to roll up the sleeves. Time for a bit of action because it's been pretty desperately quiet across markets for a couple of weeks and more maybe, and so typically this August bank holiday, once you're the wrong side of that, then really summer done. People are back. You would anticipate as we get into September, volumes are going to start to pick up, and it's a big week ahead. We've got a very big event on Friday with the non-farm payrolls numbers that I'll talk about in a minute, and you could go as far as to say the Fed's binary decision on whether to hike rates or not would almost, entirely depend on that number, I think. So anyway, we'll come on to that in a sec. But just for now, look, nice and positive start to the week. Although I say start to the week, of course, these markets we're looking at, some of them, certainly the S&P at least here, bottom left chart, was open yesterday, but of course we had a bank holiday here in the UK, and so volumes were low. But what we've got right now is equities just punching up through Friday's highs. So nice technical break here this morning at the start of the session, and equities turning on the gas. Here's the daily chart just to kind of get things in perspective. Let's just check out the Eurostoxx 50 here, and nice and positive. And actually what this means is, I'm just thinking the high point we had of the month, and we've only got a couple of days left of course, but the high of the month was set on the first, no it wasn't the high of the month, sorry, it was mid-August, but the 1st of August high came in at 30 or 3,030, and today, having just broken up above last week's high on Eurostoxx, we've just tested that level. If I was to actually just move that line and put it there, so 3,030 has been quite an important top earlier in the month. We'll see. Certainly there's positivity out there in the marketplace as we speak. The DAX also, you can see on my right hand chart, breaking up above its equivalent level. The S&P not doing so though, so just be aware of that. What you've got here on the bottom left chart is the S&P just drifting a little bit. We'll talk about yesterday's session in a minute, but certainly a positive move to the upside for the S&P, and pretty much, not far off, climbing back towards that initial punch to the upside pre-Yellen, or indeed just after Yellen on Friday. So the top from Friday's session was 2186. So we're actually good 7 points below that as it stands. So the S&P not getting involved yet in this rally. So let's just recap. You can see on certainly the S&P chart, at least now that I've got it on a 1 hour time frame, you can see this carnage, let's call it, from Friday's session when Janet Yellen delivered her speech at Jackson Hole, and then I guess more importantly Stanley Fischer followed her up. But it was a confusing initial reaction, and let's just get the US products on the screen here. So I've got euro dollar top left now. I've got the S&P bottom left, and let's just get my T-notes chart on the top right, and let's just have a little look at these. So if you like looking at the three kind of core assets, dollar denominated, so euro dollar, as I said, T-notes, and the S&P. So comparing the behavior of these charts is pretty confusing. In that if you look at the dollar first, the dollar certainly strengthened. It wasn't straightforward by any means, especially in the immediate aftermath of Yellen's speech, but look where we are now. We're trading down below the 112 handle. By the way, that's a key level, really strong barrier of resistance yesterday and going into the Asian session overnight. So the 112 handle's pretty key. As it stands for euro dollar, yesterday's low is just about containing any further downside for now, but you've certainly got dollar strength here. We've really basically traded from the 113 handle down into the 111.70s as I speak. With regards to the S&P, as I've said, actually, we've pretty much gone nowhere. Despite a pretty violent move in both directions on Friday, we reclaimed a lot of that yesterday, and actually we're trading around about 2180, which is not too far off where we were trading before Yellen's speech. And then T-notes, well, here again, a real confused picture. Fisher got things going on the downside. I'll remind you of that again in a minute, but then we drifted back yesterday. So a pretty strong correlation, you would say, between equities and bonds here. And then the dollar strengthening. So it's a pretty confused picture. So let me just remind you what happened. I mean, Yellen, as we spoke about, really the main kind of first sentence that the news wires latched onto was the fact that she said that the rate hike case had strengthened in recent months. So we got that initial hawkishness, but then further digestion of the comments, she kind of contradicted that by saying that, of course, careful consideration of any decision will be dependent on the degree to which incoming data continues to confirm the committee's outlook, blah, blah, blah. I think on Friday I mentioned the fact that perhaps the initial confusion was that in the short term she was perhaps slightly hawkish, but when looking at longer term monetary policy shifts in the monetary policy framework, perhaps that's dovish, and so there was a bit of confusion. But then what we had was Fisher got interviewed on CNBC, so this was around about 4:30 p.m. on the Friday, and he was not messing about, because basically what he said, he got asked. He was asked by the interviewer on CNBC if we should be on the edge of our seats for a rate hike as soon as September, and more than one hike this year. And his answer to that was, what the chair said today was consistent with answering yes to both of your questions. So, that's pretty clear cut, especially for a central banker. And this is what got the hawkish movement going. And so in the end, the S&P swung from 2186 on the upside and finished up bottoming out at 2157. So a near 30-point sell-off before then we stabilized into the close. Hawkishness with regards to the the dollar then breaking the Yellen low, which was at S2, which was at 112.50, and then extending down, almost another 100 pips. And then T-notes also selling off sharply as yields rise in the face of perhaps forthcoming rate hikes. Okay, so you've got an increase in the probability now of a September hike before any Yellen. So let's say on Thursday night last week, the probability of a September rate hike was 32%. It's now 42%. With regards to December, chances of a hike by December on Thursday was 57%. It's now up to 65%. And basically, we've got this meeting that's coming 21st of September, and I've certainly been saying I believe the Fed should hike, and after what I've heard at the end of last week, really it pretty much comes down to this single number. This is the chart for non-farm payrolls. We've had a couple of very strong readings in a row. If we get a third, I think it's done. We're going to get a hike in September. Let's get on with it. Let's get used to it. I think anything above 200,000 and September hike. Anything below 200,000, fine. We'll wait till we've had the election and let's just maybe look to try and hike in December. But I think that ultimately the Fed don't get many chances to hike. The ducks don't align very often. There's so many moving parts in their decision-making process that rarely do they all line up. I think that they are lined up and they should hike. If they don't, they'll regret it. By the time we get to December, who knows? Trump wins the election and, I don't know, markets panic. There's going to probably be another reason that materializes. So I think the Fed should get on with it. But, of course, we'll see. Before we get to Friday's payrolls number, we'll have a little bit of an insight from the ADP reading, which will be tomorrow at 1:15. This is looking at private sector job creation, of course. This has been a hell of a lot less volatile, but it has been drifting higher over the last few months from that April low. And so we'll see what we get here. I have to say this has been a pretty rubbish lead indicator for payrolls data, certainly for the last few readings. So whether the reading tomorrow is going to be of any use to us in guiding us as to what we're going to get on Friday, certainly debatable. But given the importance of Friday's reading now, I really do think it's above 200 and we'll get a September hike, which means markets are going to have to start pricing that in more, because we're not priced in for that yet. If you think about the dollar, let's look at a daily chart here on euro dollar, make that a bit bigger, then we're trading middle of the range that we've seen since Brexit. Here's the Brexit sell-off, and we're about middle of that big candle. And so, there's plenty of room to move down to the 110 handle and below. 109.47's key on the downside, and a really strong payrolls number on Friday, and we can easily get down there. So this is something to be aware of. Of course, a really weak number. Well, now there's room to move back higher, of course, given that we've had this dollar strength since Friday's Fed comments. So there's certainly room to move on in either direction. With regards to the S&P, if you look at the daily chart, then at least we had a little bit of action. I mean, it's been a ridiculous period. We went 33 consecutive days without a move of more than 1% on any one day, which is incredibly, dull, let's be honest. This is just locked in at the top. This is the all-time highs. We had a bit of action on Friday. We've had some action yesterday, so let's just bring you up to date on that. If you were, not plugged in yesterday because of the bank holiday, what happened? Well, we had some comments over the weekend, and the theme is definitely still on monetary policy, but it's not Fed policy, it's Japanese, because Kuroda, the head of the central bank in Japan, made some comments over the weekend, and this is going to be interesting because their next meeting is on the 20th and 21st of September, which is exactly the same 2 days as the Fed's next meeting. What did Kuroda say on Saturday? He said that the bank would not hesitate to boost monetary stimulus if needed, and that there is no doubt that there is ample space for additional easing in each of the 3 dimensions. I guess what he means by the 3 dimensions is certainly interest rates, it's quantitative easing, and most likely I think he's probably referring to communication as the 3rd dimension. But let's just look at the dollar yen here, because this is how this has behaved. On Friday we got some decent upside off the back of dollar strength, and then this was helped and we're sustaining this as a result of bit of yen weakness. You had a real boost on Japanese stocks yesterday. Japanese stocks were up 2.5% thanks to yen weakness, and this is perhaps fed through to the S&P, which also moved higher yesterday off the US cash open. Yesterday the S&P ticked up through the 50% fib of Friday's session, and managed to almost get back up to Friday's high, but not quite. So it's almost like with the equity space, given that we've had that move higher this morning, it's almost like that, okay, yes, the Fed have now guided up probabilities of rate hikes, but actually maybe we're comfortable with that, with Japan ready to maybe pull the trigger and deliver more. Of course, the Bank of England have already delivered more a few weeks ago. So maybe it's the thought that we're comfortable with this. What I would say with regards to bonds is that T-notes are still, and not just T-notes, and perhaps more importantly, looking at the shorter end of the curve, we're still way... hang on, sorry, let me just sort out this chart. We're still a million miles off pricing the rate hike, if there is to be one in September. Let me get my chart up down here. So we're a long way off pricing this in, and so there's certainly room to move. I think the best case scenario for us as traders is that we get a strong number on Friday and we really start pricing in a September move. Right, let's just focus a bit more on this week then. Here's the calendar for today. And there's a lot of stuff on this calendar, but unfortunately not much of it is that interesting. We've got, throughout the whole morning, German inflation numbers coming in regionally. So Saxony's already delivered, and that came in below expectation on the month-on-month reading, but in line on the year-on-year. So at 9 a.m., which is in about 12 minutes' time, we're going to get Bavaria, Brandenburg and Hesse. North Rhine-Westphalia coming at 9:30. Before I'll show you, I'll just scroll down. You get the whole country, the German CPI reading for August, being delivered at 1 p.m. Okay, so lots of German inflation figures drifting in through the morning. On the UK side, we've got some money supply and mortgage approval numbers. Now, the mortgage approval numbers might be worth a look, just from the point of view that, you know, this is July data, so this is absolutely, you know, hard data from the post-Brexit period. There's been concern about the housing market and how it might get damaged by this uncertainty, and so actually this mortgage approval number for the month of July might be quite interesting. So that's at 9:30. At Europe at 10, we got some sentiment numbers which look like they might be important, but actually aren't really from a market sensitivity point of view. As we go into the afternoon, there's actually nothing from the US of note. We've got a Case-Shiller house price index number, but that's coming at 2 o'clock. But really, you know, the kind of main event for the week, and let me show you the week's calendar. If we just scroll down, here's Wednesday's data. We've got some German employment figures in the morning. We got the CPI number for Europe as a whole. Also, they're the kind of big numbers of the morning, and then in the afternoon it's the ADP number, and it's Chicago PMI and pending home sales, and then of course we get the crude oil inventories data as well. Just be aware that we also get Chinese data tomorrow night on the manufacturing side, which will be interesting to get a gauge on. Just on Thursday then, scrolling down, we get manufacturing numbers. This is the first day of the month, of course, so Thursday will be 1st of September. So traditionally, this is the day we get manufacturing numbers for the month of August. These will be final readings out of Europe. We'll also get the US numbers as well. ISM manufacturing being probably the most important one out of all of this lot. And then Friday, it's quiet, other than the absolute big giant number of the whole week, which will be the payrolls number. As it stands, and this will change, but the current forecast is 186,000, which is probably just about low enough to prevent the Fed from hiking. I think that 200 number's the kind of key line in the sand. So this is the data for the week. A couple of other things then, just to be aware of as we go through the week, and headlines and so on. We've got some Spanish political risk in the mix. Rajoy is under pressure, and we are going to have a vote, or he, I should say, is going to have a vote of confidence in the Spanish Parliament. It might take place tonight, or perhaps more likely tomorrow. He needs 176 seats to win his confidence vote. At the moment, he currently has support of only 170. So he's got some work to do today to try and swing 6 more people to swing across and vote for him. So this will be in the mix. Also, I was just reading an article this morning about Angela Merkel, because next year is quite important for Europe politically. We've got French elections, we've also got German elections. So the biggest 2 countries in mainland Europe have key elections. Merkel is yet to actually confirm that she's going to be running for what would be a remarkable 4th election, a 4th term. She's yet to actually confirm, and on over the weekend she was interviewed on TV and refused to confirm. So, I mean, imagine if Merkel doesn't run. I mean, that would be. I mean, she has been the one consistent kind of stable political force, and if she were to stand down, that would really ramp up political risk big time in Europe. There's a party in Germany called the Alternative for Germany Party. They're like the UKIP of Germany, if you like, and they've been gathering a hell of a lot of momentum as a result of the migration situation in that country. So Rajoy here today, delivering some Spanish political risk, but we've certainly got political risk, especially with Trump and Clinton going head to head in November. So this is definitely going to be a key theme that's going to stay with us in different forms over the next 12 months or so. Let's just finish looking at some commodities. Let's look at oil here, top right. I've got the gold chart, bottom left. So with oil, lots of choppiness and volatility off the back of really dollar movement at the end of last week. And really where we're trading now is not too far away from where we were trading before Yellen's speech and the dollar action. Let me go to a daily chart just for crude. It's been a remarkable period with the big sell-off to $40 and then the big rebound. Maybe we're in for a bit of calm here now. We've obviously got this IEA meeting in September with all the rumourings around kind of side meetings going on with OPEC, and it was last week it was Iran's turn to say yes, we are going to be there, and yes, we are going to be involved in these meetings, and therefore increasing the likelihood of some kind of coordinated freeze on output from OPEC. So this led to a bit of downside for crude last week. So just keep your ear to the ground on any more news ahead of that meeting in September. But I think perhaps now we've had this huge move down and back up, we may get a period of consolidation now ahead of that meeting that's in a few weeks' time. So that's oil. With regards to gold, well, very sensitive obviously to monetary policy developments. What happened at the end of last week then was gold shifted lower. We got some dollar strength. We have had, albeit confusingly, we have had an increase in the probability of a rate hike, and so this has taken gold down to a price almost to a price you've got to be aware of, and that's the 2-month low set back mid to end of July at 1310, and then the 1300 handle are very important. So keep your eye on these prices for gold, and if the dollar remains strong this week, and it will do if we get things like a strong ADP number, or if we get a strong employment component from the ISM number on Thursday, for example. People are going to start to build in a strong payrolls number, and therefore the probability of a rate hike in September will increase. Okay. So how might that affect oil? Well, I think it's probably straightforward. I think the dollar is actually back as perhaps the key sort of market, and I think everybody's looking towards the dollar. If you get dollar strength, I think commodities are going to come under pressure, and vice versa. If you get dollar weakness, let's say we get a bad ADP number tomorrow, well fine, the dollar will weaken and commodities might well lift off the back of that. But with oil, don't forget the output numbers. We'll get the ADP, no we won't, the API data tonight, and then Department of Energy inventory numbers tomorrow, with the production output data, and then don't forget any rumourings about that meeting as I mentioned. Okay, all right, let me leave it there then. We got some data out of Europe coming at you in 3 minutes time, and this will be a whole raft of regional German inflation numbers as well as Italian retail sales. All right, that's it for now. Enjoy the day, enjoy the week. Thanks.